Okay, let's dive right into this. Welcome to the Explainer. Today, we're taking a really close look at an absolutely monumental move in the Indian automotive sector. We're breaking down the massive Rs 5,633 crore share buyback that Bajaj Auto just announced. And honestly, this isn't just your standard corporate press release. It's practically a masterclass in capital allocation, strategic timing, and, well, maximizing shareholder value. We're going to look closely at the raw numbers, the macroeconomic tax shifts that totally triggered this, and what it ultimately means for retail investors who actually hold the stock. So let's get right to it.
So here's our roadmap for today. We'll start with the record-breaking buyback, move into the blockbuster Q4 earnings, and explore the budget 2026 catalyst. Then we'll decode the mechanics of share buybacks before opening up the retail investor playbook. All right, Section 1, the record-breaking buyback. Let's look at exactly what they're up to. Just look at that number for a second. Rupees 5,633 crore. That is the total size of the share buyback approved by the board over at Bajaj Auto. This staggering figure is exactly the reason we're analyzing this company today. I mean, it's easily one of the most aggressive moves we've seen in the auto sector lately, and it's custom designed to return a massive chunk of capital directly to the people who own a piece of the company. Let's break down the actual nuts and bolts of this offer. The company is planning to scoop up to 46.94 lakh fully paid-up equity shares. That represents about 1.68% of the company's total outstanding equity. But you know the real headline here? It's the price, $12,000 per share. When this was first announced, that price represented a nearly 16% premium over the existing market price, which was hovering around the $10,383 mark. And importantly, they're doing this via the tender route. Basically, that means shareholders have to actively raise their hands and choose to offer their shares back to the company at this premium price. Moving to Section 2, blockbuster Q4 earnings. You might be wondering, how on earth can they afford this? Well, the answer lies right here in this double whammy of growth. For the fourth quarter of the 2026 financial year, Bajaj Auto reported a standalone net profit increase of 34% year-over-year. That's hitting Rs 2,746 crore. Alongside that, revenue from operations surged by a seriously impressive 32% to Rs 16,006 crore. Look, you don't just randomly announce a 5,000 crore buyback unless your core business is generating absolutely massive amounts of cash. And this brilliantly illustrates that Bajaj Auto's engines are running at maximum capacity right now. Digging a bit deeper into the weeds here, the company saw its core operational profitability, its EBITDA margin, improved to 20.8%. This was totally driven by a fantastic 24% year-over-year rise in volumes, with both domestic sales and exports seeing huge jumps. And because of this incredible performance, management decided to reward shareholders in a major way. Get this, on top of the buyback, they announced a 150 per share dividend. When you combine the dividend and the buyback, the total payout is an astonishing Rs 9,825 crore. As management pointed out, this equals literally 100% of the year's profit after tax. They made the profit, and they're handing every single bit of it back. Section 3, the Budget 2026 Catalyst. Why are they choosing to do this right now? Okay, so the crucial point here is that the government fundamentally changed the rules of the game for how buybacks are taxed. Before April 1, 2026, the entire proceeds you got from a buyback were taxed as a dividend, straight at your individual income tax slab rate. For high earners, that was a massive tax bite. But post-April 1, 2026, only the actual gains are taxed, and they're taxed under capital gains provisions. This means a much, much lower rate, either 12.5% for long-term capital gains or 20% for short-term. Plus, you can now offset capital losses against these gains. It basically went from being heavily taxed to being incredibly taxpayer-friendly overnight. And because of this massive tax shift, Bajaj Auto definitely isn't the only company making this move. This regulatory tweak triggered a huge wave of buybacks across corporate India. I mean, Wipro announced a staggering 15,000 crore buyback. Zydus Life Sciences bumped theirs up to a 1,100 crore outlay. Companies like Aurobindo Pharma, Kajaria Ceramics, and Cyient, they've all jumped on the bandwagon. Corporate boards across the country clearly recognize this new tax-efficient reality and acted on it fast to reward their shareholders. Which brings us to Section 4, decoding share buybacks. Let's make sure we totally understand the financial mechanics at play. Just to anchor us, here is a super simple, clear definition. A share buyback is basically when a company uses its accumulated cash to purchase its own outstanding shares right back from investors. Once they buy those shares, they cancel or extinguish them. Poof. This permanently reduces the total number of shares available on the open market. It's like shrinking the pie, so every remaining slice gets a little bigger. So, why do companies actually do this? Let's rapid fire the corporate benefits. First up, EPS improvement. If the overall profit stays the exact same, but there are fewer shares in existence, the earnings per share automatically goes up. Second, it provides share price support. By buying at a premium, like Bajaj is doing, it props up the stock in the open market. Third, it's all about management signaling. When a company buys its own stock, management is basically shouting from the rooftops that they believe their shares are undervalued. They're betting on themselves. And finally, as we just saw, it's currently a highly tax-efficient way to return cash to shareholders compared to those hefty old-school dividends. And finally, Section 5, the Retail Investor Playbook. What does this actually mean for you? This is the million-dollar question for anyone holding the stock, or maybe even considering buying it right now. Should you participate in the buyback? Look, with the stock trading on the open market lower than that Rs $12,000 buyback price, it seems like an absolute no-brainer to try and capture that premium, right? But evaluating your own portfolio strategy requires looking at the finer details of how this tender offer actually works in practice.
Now, what's really interesting about this slide is this specific number, 15%. According to the market regulator SEBI, 15% of the total buyback offer size absolutely must be strictly reserved for small shareholders. What does that mean? It means retail investors who hold shares worth less than rupees 2 lakh on the record date. So out of that 5,633 crore pie, roughly 845 crores is ring-fenced just for retail investors. This rule is designed to give everyday folks a much better chance at participating in this premium payout.
But yeah, there's a catch, and it's a vital one. Based on current market data, the projected acceptance ratio for retail investors is only about 11%. So, even though promoters are expected to abstain from the buyback, which usually really helps retail investors out, the sheer number of qualifying small shareholders out there means the company will likely only accept about 1 out of every 9 or 10 shares you actually try to tender.
Let's just take a quick step back and see how this builds a much larger narrative. Look at this timeline of Bajaj Auto's history with buybacks. Back in 2022, they bought back stock at Rs 4,600 per share. By early 2024, they did it again, this time at Rs 10,000 per share. And now, in 2026, the price is up to Rs 12,000. I mean, that is just a phenomenal track record of wealth creation. Long-term investors who simply sat tight and held onto their stock through these cycles have seen the value of their holdings absolutely skyrocket, fully supported by a management team that is relentlessly focused on growth and returning capital.
So, we're going to end on this somewhat provocative question. Analysts out there note that if you are a long-term investor, just holding the stock makes a whole lot of sense, given the company's clear growth potential and strong history. But if you're looking to buy the stock today, simply to tender it for a quick arbitrage profit at Rs 12,000, well, you've really got to weigh that sweet 16% premium against the harsh reality of a low 11% acceptance ratio. Does that balance of potential reward and mathematical risk actually justify a place in your portfolio? That is the ultimate takeaway you need to evaluate for yourself. Thank you so much for joining me on this deep dive into the Bajaj Auto Explainer. I really hope this breakdown brought some serious clarity to your investment strategy today.